Many business owners plan for rent, payroll, and inventory, but one broken machine or sudden tax bill can flip cash flow overnight. The scary part is that these surprises don't wait for the right time. In this video, we'll break down how to budget for unexpected business expenses. Let's imagine a mid-size HVAC installation and maintenance company based in North Carolina that serves restaurants, schools, and small commercial buildings. The business looks stable because it has recurring service contracts and steady seasonal demand. But we'll break down how they budget for unexpected expenses using real numbers, disciplined allocations, and controlled cash planning. The company generates monthly revenue of $220,000 from installation projects, preventive maintenance contracts, and emergency service calls. Their cost of goods sold, including compressors, copper tubing, ductwork, refrigerants, and labor consumed in installations totals $110,000. That leaves a gross margin of $110,000. Operating expenses include $42,000 payroll for office and field staff, $8,000 rent for warehouse plus office, $3,500 utilities, $3,000 insurance, $4,500 fuel and vehicle maintenance for service vans, and $3,500 miscellaneous overhead. Total operating expenses equal $64,500, leaving operating profit of $45,500 before taxes. So far, the company looks financially healthy. Now, here is how they prepare for unexpected expenses. First, they use a rule that 10% of gross margin automatically flows into a reserve account labeled contingency and reactive costs. Since the gross margin is $110,000, they transfer $11,000 each month into that reserve. This account is not for taxes, marketing, or payroll. It is strictly for shocks like vehicle breakdowns, failed equipment returns, refund credits, compliance fines, warranty liabilities, or sudden price spikes in refrigerants. Second, they track unexpected costs using a rolling 12-month look-back model. In the previous year, they experienced a $20,000 van transmission failure, a $9,000 refund credit for a faulty rooftop unit that failed within warranty, and a $5,200 OSHA safety compliance upgrade for ladder harness systems. Total unexpected cost in the year was $34,200. Dividing that total by 12 months gives approximately $2,850 as the baseline monthly shock value. With inflation and supplier price volatility factored at roughly 18% due to metal and refrigerant price fluctuations, their target baseline becomes about $3,360 per month. Let's see how this plays out in real operations. After 6 months, at $11,000 per month, the reserve account reaches $66,000. During the 7th month, one of the service vans suffers engine damage, and repairing the engine plus towing and diagnostics costs $17,500. Instead of delaying customer jobs, taking high-interest equipment, finance, or putting the cost on a credit card, they pay from the reserve. If they had used short-term financing at 15% APR, it would have cost over $2,600 in interest across 12 months. Instead, they avoid interest, maintain credit capacity, and keep service schedules on time. 2 months later, a major installation job produces an airflow issue due to defective duct materials from a supplier. The HVAC company processes a refund credit of $6,800 to the client and absorbs the cost of rework labor. The reserve still holds more than $40,000, so business relationships stay positive, warranty claims are handled professionally, and brand reputation with commercial customers stays intact. Here is the advanced layer. The company uses 3 probability classes for planning. Low probability but high impact events like vehicle accidents or lawsuits are covered by allocating 1% of revenue to contingency value. Medium probability, moderate impact events like compressor failures or warranty labor are covered by allocating 2% of revenue. High probability, low impact events like invoice adjustments and overtime hours are absorbed using monthly operating margin flexibility. This keeps decisions rational instead of emotional. By the end of the year, the company used about $31,300 from the reserve, but built it back up to $72,000 using planned allocations and high-demand summer months. The owners now make growth investments like hiring technicians or adding maintenance contracts without fear of being blindsided. The lesson is simple: businesses do not collapse from lack of profit. They collapse from lack of liquidity at the wrong moment. This HVAC company stays stable because it treats unexpected expenses like a mandatory budget line, not a surprise that magically solves itself. A lot of businesses get blindsided not because the surprise expense was huge, but because they never planned for it. Here are the common mistakes, practical tips, and useful tools that make a real difference when budgeting for unexpected business expenses. First, the biggest mistake is treating emergencies as rare events instead of recurring parts of business operations. Machines break, vehicles fail, refunds happen, regulations change, and taxes surprise new owners. Another mistake is mixing operational cash with contingency funds. When everything sits in the same account, owners overspend during good months and choke during bad months. A third mistake is relying only on profit numbers instead of liquidity. Profit exists on paper, but payroll, refunds, repairs, and penalties demand real cash. A fourth mistake is underestimating warranty liabilities, compliance upgrades, and equipment downtime. These don't show up on the income statement until they hit, and then they hit hard. Now let's talk practical tips that actually work. The first tip is to allocate a fixed percentage of gross margin into a separate reserve account each month. This creates predictable funding for unpredictable events. The second tip is to run a 12-month look-back analysis to understand historical surprise costs. You cannot manage what you never measure. The third tip is to classify unexpected expenses into probability and impact buckets. Low probability, high impact items need contingency percentage allocation. Medium probability, moderate impact items need repair and warranty buffers. High probability, low impact items should be absorbed by operating margin flexibility. The fourth tip is to document supplier, legal, and compliance risks once a quarter, so nothing becomes invisible over time. The fifth tip is to plan for timing gaps. A sudden repair in the same month as quarterly taxes or insurance renewals can destroy cash flow if timing is ignored. Now, a few tools serious business owners use. For accounting, tools like QuickBooks Online or Xero help track liquidity, not just profit. For scenario budgeting, software like Float or LivePlan can model what happens when a machine breaks, demand drops, or taxes spike. For maintenance-heavy businesses, CMMS tools such as Upkeep or MaintainX track equipment life cycles and reduce downtime surprises. For spending control, corporate cards like Ramp or Brex allow configurable budgets per category so emergency repairs don't consume marketing funds. And for documentation, Notion or Google Workspace keeps safety compliance, warranties, and vendor contracts in one place, so no deadlines or liabilities are forgotten.